This is our Forex blog for February 21st, 2013, and there's so many different ways to trade using our software. I don't go over more than just one or two different methods in the blog video, and I tend to focus on the blog videos with our latest and our best trading methods. These are currency indexes that we've created that show you what each currency is doing versus all the rest of them, and it's in chart format, so you can see, for example, when the dollar index breaks out over yesterday's high, that's typically very bullish. They tend to act and find areas of support resistance, like the euro dollar when it broke down underneath the previous day's low. That's a very big sign of weakness. This is an event that makes it worth risking your hard-earned money on taking a trade. And you can see, the euro dollar index just fell, came back up to the hourly moving average, had a false breakout here, went back down at 11. That also was a very high probability event. Because the trend's down, you can clearly see real-time the statistical momentum is extremely weak. That's a very weak currency. And one of the stronger ones, the yen, it was above its hourly pretty much all day until about 3 o'clock today. So, when you get a strong currency like this, and you get a pullback, and again it kind of goes sideways for a little bit and then breaks out again over the previous day's high at 3 o'clock. Well, guess what? At 3 o'clock, the euro was extremely weak, and the pound, let's hit the minus key and zoom out, it was weak earlier, but it was kind of coming up at that time, whereas the euro was kind of going sideways and just broke down. One of the higher probability trades at 3 o'clock, therefore, is to just simply sell the euro yen. It's that simple. You have a weak currency and a strong one when the weak currency is on the bottom. Again, when this broke out, you saw this chart come down, and notice how this one came up and hit our bands, pulled back a little bit, went sideways. You can just simply move your stop up underneath these lows, and as long as the price of the yen index can't come underneath there, it's likely to make another wave up. Also notice our FX trend intensity, plus 80 strength. Now plus 80 strength trends probably 75–80% of the time will continue, especially if it's the first move after a consolidation, which you can see the market kind of had a false breakout earlier, went sideways, consolidated, broke out. This was incredibly strong. This is a very high probability pattern. And you had the exact opposite with the euro. It was just going sideways. It wasn't able to get above the previous day's, or I should say the hourly moving average in gray there. Very high probability trade, and it's likely to make at least 2 waves down. So you draw your fibs on there, and this fib target I would have got out of half. You can use our trailing stops chandelier, is a very high probability one. And you can see that kept you into the trade for the whole way down, and most of the time the market doesn't go below the 1.618. So at 7 o'clock right here, you're watching the indexes like a hawk. The euro index is underneath the 2.0 containment band. That's usually where the market's going to reverse at, and at 7 o'clock this one's also extended too much. So both the yen has gone up statistically too much, and the euro has gone down statistically too much, and it's at the 1.618 fib target. You don't need much more other than that to consider getting out of your trade and really looking for a counter trend trade if you're so inclined. I prefer using range charts. I would go down to maybe a 3 or 4 pips per bar range chart anytime you're doing counter trend trades. Let's scroll this thing back at 7. So if you're going to do a counter trend trade using a 3 pips per bar chart, they're not time based, obviously, and you can kind of, when you see a little pattern like this near the lows, get into that trade somewhere around 35, maybe get out of it when it goes 1 or 2 waves up. Don't get greedy when you do counter trend. So you're in that around 35 and out at 55. You made 20 quick pips, and it's pretty clear that the trend's not done. So you might have bought this little pullback right here. It's kind of chopping around up here. I would always draw my fibs on it on this last move, and probably get out of this last trade here at 79, not anticipating it going up anymore. But if you're watching that currency and it's going up and then sideways, you put your stop underneath there, In this case, the yen was coming down and went sideways. It's one of the easier ways of trading. The pound, was very weak earlier. You can see it went up with a lot of statistical momentum and then kind of went sideways. Here's the 15-minute moving average, finds resistance there, which oftentimes happens, and then breaks out right here. It's likely to go up to the hourly, and if it shoots through there, the upper bands. You can also use these to anticipate reversals. For example, the dollar. It went up and has a double top right here. It's above the previous day's dollar index high. But notice the momentum the first time up is more than the second one. And so you can zoom in on this and kind of draw a trend line underneath these bars lows. And when that breaks down right here with this clear reversal pattern, it gets short the dollar around 550. Now, what's one of the stronger ones at 550? Well, the pound had been exploding up, had a little pullback at that time with very little weakness in comparison to the previous strength. 530 makes an excellent time to be looking for a pound dollar buy, because the dollar is likely to reverse and the pound has a continuation, or actually the pound had a little bit of a pullback. You get into that trade right here, you draw your fibs off that last wave. And one of the keys to trading is small losses, big wins. Anytime you take a trade, you're going to put your stop typically a pip or two underneath the swing low. So in this case, you're risking about 10 or 11 pips. That's it. This is your risk. And your profit target is keep hitting Shift L instead of Control L. Your profit target is the fib target level. So as you can see, your profit in this case, and it panned out, it worked, is over 3 times bigger than what your risk is. And all found by very clear patterns on our indexes. The dollar went up, pulled back, went up again, didn't have extreme momentum and had about a third less momentum than it had before. And the pound kind of exploded up off the lows. And you can always, on the indexes, go to a 30-minute or 60-minute, whatever time frame you want to see. And you can see the pound kind of was going sideways and went down one day, went down 2 days. You can always draw fib areas on these charts to get an idea. This was a 2.0 fib move. It was also near our lower containment bands, very likely to reverse. And it came off the lows. Because it's down statistically so much, it's going to really take a while to retrace back up and possibly trend down again. So you have a lot of potential upside in the pound that was down too much. Going back to the 5-minute chart here. And of course we have these indexes on all the different currencies. Here's the Swiss. It breaks down here at 3 o'clock. It wasn't able to get back above its hourly, very weak. In fact, a skilled trader probably would have gone short this right here, quite a bit earlier, right around 325. 325, we have a strong yen. So what do? You simply you sell the Swiss yen. And you can see it fell from 160 down to 06. Nice 50 or 60 pip move, or if you use our trailing stop, you made even more. Short at 50, out at 78. So you made 70 pips. And most of the time you're going to choose just simply draw your fibs on the previous swing. And I always tend to get out of half the trade here, and then when it goes down to the next fib target, you can see, like I said earlier, about 70-80% of the time, this is where it's going to end the move. As soon as it comes back up, I'm out here. So my average exit for both trades would have been here at 69 versus 77. Would have made another 8 pips using Fibonacci profit targets. And that's it. This is one of the easiest ways of trading. If you watch a couple days worth of blog videos, you should be able to spot significant events like breaking down from above to below the previous day's low, breaking out above the previous day's high for the yen index here, if you look at a 30-minute, 60-minute, or 240-minute pound chart, you can see the pound is down too much, and hit the lower containment band, it was likely to retrace back up maybe to the upper bands, which it did. You never know if that's going to happen. Sometimes it just works its way up to the hourly and then comes down again. Maybe it double bottoms and then makes its big move later. You never know what's going to happen, but the point is, when wrong, you're going to have 6 to 10 pip losses. And when right, as you've seen, you're going to frequently get 20 to 50 and sometimes 70 plus pip wins. Small losses, big wins. Don't worry about winning percentage. That's a silly thing to worry about that most new traders focus on. What you need to focus on is the expectancy of your system. If you're right 40 or 50% of the time and you get 30 pip wins and you're losing less than 10 pips when you're wrong, you're going to be very happy with your results. That's my only point when it comes to winning percentage. You don't need, I've seen traders with 80-90% winning ratios lose all their money because they take 3 to 5 pip wins, and then I saw one trader take a 1,000 pip loss. That's ridiculous, you know. So winning percentage is bullshit. Focus more on big wins, small losses.